What's going on, guys? Alex here, and today we're going to take an in-depth look into two provisions of the CARES Act, known as the PPP, the Paycheck Protection Program, and also the EIDL, the Economic Injury Disaster Loan Program as well. See what kind of benefits are available, see what kind of news has come out regarding these programs, because the last few weeks have been a whirlwind, to say the least. But before we get all on that good stuff, how you guys doing today? All right, if you guys are here, drop me a comment, let me know how things are going, how's quarantine treating you, and then we'll get into the serious stuff shortly here. So stick with me. We've got a bit of a agenda here for you. Now, we're going to start by taking a look at a bit of a retrospective. Just understand what we're even talking about when we say Paycheck Protection Program, EIDL, grants, loans, all this craziness, and get an understanding of the 30,000-foot picture, okay? And this will give us a lay of the land and allow us to understand exactly how these things are structured, what kind of benefits are available out there, and possibly what application these things can have to your particular business, whatever that happens to be. Now, I'll say up front that this presentation is geared towards what would be called smaller businesses, right? Every business is big to the business owner, but in this case, we're definitely talking below 500 employees, and I think that would summarize most of the people watching. So if you have a business with more than 500 employees, then this may not be geared really towards your situation. So I just want to lay that out up front. Now, once we get a lay of the land, kind of understand what we're talking about in general terms, we're going to look at a bit of a retrospective and get an idea of how this thing has played out over the last few weeks. Once we do that and we understand we have our bearings, then we're going to go back through and take a dive into the mechanics, into the details, and how you can apply this from a practical perspective, right? Because when you read these articles and you look at the news, sometimes it's hard to wrap your mind around, okay, what steps do I take, or how exactly do I move forward? And understanding the mechanics is where you can really tie it to your business and see if this is something that you can or want to take advantage of. That's the agenda for today. Now, with that, a few disclaimers before we get into all of the goodness. First of all, this is not legal or tax advice, okay? Everybody's situation is different, so I'm not recommending you to take these loans. I'm not recommending you not to take them, but definitely putting the information out there so you can make your own informed decisions. And you should absolutely consult with a professional before relying on any of the information presented in this video. Really important. Next, the information is subject to change. This program has been changing since the ink barely dried on the bill itself, the 880-page CARES Act. And literally on a daily basis, new guidance has been put out that has changed our perception of how these things are functioning and how it applies, to whom it applies, what the rules are. And it's really morphing as we go. And I'll even show you where some of the guidance is contradictory from one day to the next, as far as what constitutes even a simple thing like payroll costs. All right, you'd think that'd be pretty straightforward, but as you could see, as I'll show you, the definition of that simple term even changed over time. So we're gonna touch on that as well, but just keep in mind that things are subject to change. This is still a fluid situation. Finally, consult with a professional. All right. There's a lot of complications that get involved with loans, grants, forgiveness, especially unemployment, employment issues. So if you're laying off employees, hiring back employees, you want to make sure that you don't run afoul of any of those employment-related rules to try to take advantage of some possible tax or loan benefit or economic disaster relief. So you don't want to have the tail wag the dog in these cases. So certainly consult with professionals to make sure that in your particular situation, there's not something that you're missing. That'll be very important to keep in mind. All right, so with all of those disclaimers out of the way, what are we even talking about? Paycheck protection, EIDL. Let's back up. So in March, it became clear that this coronavirus thing was going to impact the economy pretty heavily. I mean, it was probably clear before that, but certainly was undeniable at that point. And the government put together a program whereby they would provide stimulus for businesses to try to avoid what would turn out to be economic disaster, right? Because if businesses can't open their doors, they can't have customers, they don't have revenue, they can't pay their employees, so on and so forth. You want to avoid having mass unemployment in the situation. So the idea was, hey, let's get ahead of this thing and try to help businesses and also individuals. There's also that stimulus payment of the $1,200, but this was geared towards businesses in particular to try to sustain the economy through the small businesses, or relatively small, we could touch on that later, in the United States. So that was the idea behind the PPP, the Paycheck Protection Program, and the EIDL. All right, so there's two sides to this thing. And let me put on the screen a spreadsheet that we did in an earlier video. And this kind of lays out how this thing is structured. So on one side, you have this kind of gray area, and that's because those two elements are linked. So when you look at EIDL, or when you consider economic injury disaster loans, it's important to keep in mind that this up to $10,000 EIDL grant is part of the same element of the CARES Act as this economic injury disaster loan provision. So they live in the same place. They have the same apportioned amount, appropriated amount. So it's the same $10 billion that was originally appropriated. So that's why this gray headline kind of covers both those columns, because they're very much related. On the other hand, the Paycheck Protection Program is still a part of the CARES Act, but it lives a little bit separately in terms of the requirements, in terms of what it's geared for, and really the intent of that provision is a bit different than that of the EIDL. We'll take a closer look at how that is. But for now, if you want to conceptualize the differences between these two programs, I think a great key word on this EIDL side is disaster. All right, so it's really geared towards providing disaster relief, and we'll see how that works out. That's where the focus is. On the other hand, with the Paycheck Protection Program, the main word there that you need to keep in mind is, you guessed it, paycheck. And the idea is to try to avoid that mass unemployment, to try to have employers have an incentive to keep employees on payroll and avoid firing everybody. Because then it becomes the state's problems, it becomes the federal government's problem. They said, hey, if we can help employers maintain the employment where it is, that's going to be good for everyone, and that's what the Paycheck Protection Program is geared for. Now, in terms of the original appropriation, it was $10 billion on the EIDL side and $349 billion on the Paycheck Protection Program, PPP. So you could see where the bulk of the funds were allocated initially, definitely towards the PPP side. So that's where a lot of businesses were kind of focusing their efforts in terms of getting this relief, as opposed to the EIDL side. But there's pros and cons on each of these, in each of these areas. We're going to take a look and understand that a little bit more. And for now, just keep in mind that this EIDL grant, we're talking about on the economic injury disaster loan area, part of the provision was a grant of up to $10,000 per business. The idea was, hey, whether or not you get the EIDL loan, we want to give you up to $10,000 right up front as an advance. And if you use it for particular business-related purposes, you don't have to pay it back. So theoretically, you can be approved for a $50,000 economic injury disaster loan and still receive up to $10,000 on the EIDL side. $10,000, as long as you use it for business purposes, you don't have to pay it back. It's an advance. It's forgivable. It's a grant, however you want to call it. But that's up to $10,000. That was very controversial because when this first came out, the way it was reported in the news is that every business gets $10,000. And if you look in the bill, there's a provision there that says businesses may request up to $10,000. And there's a lot of controversy about that. As this program played out and as things were changing overnight, this up to $10,000 became $1,000 per employee. All right, so that's nowhere in the bill. If you read the CARES Act, it says up to $10,000 advance may be requested by the business. This particular area was changed to $1,000 per employee. So if you're a self-employed individual, this means that you'll essentially get $1,000, assuming you don't employ any other employees. If you have 5 employees, then you get up to $5,000. That's an example of how this thing changes over time. So you have to be very careful. And whenever you're reading about this, you want to make sure you're looking at the most current information because it may very well be outdated several days from that date. Now, that's the EIDL grant. Okay, so theoretically, a business can get $3,000 deposited into their account. You use it for business purposes, specifically these areas here: paid sick leave to employees unable to work, if you maintain your payroll, increased costs due to supply chain disruption, rent or mortgage payments, or repaying obligations that cannot be met due to revenue loss. So you see there's some definitely payroll in there, but that's not the main focus, okay? Not as much as it is here. So that's the $10,000 up to $10,000 EIDL grant. If you're self-employed, you're just working by yourself, it's $1,000 that they're going to give you. You don't have to pay back. If you have 3 employees, then you get $3,000. Pretty simple on that front. It's nowhere in the bill, but I guess that's how they're treating it, to spread the wealth, if you will, a bit more across the vast number of businesses that need it. Now, on the EIDL loan side, this is where things get a bit more interesting, because the idea here is that this part is not forgiven. At this point, you say, not forgiven? Why would I even consider that? That's crazy. But the interesting part is that this is up to $2 million. All right? This grant was up to $10,000 potentially. This is up to $2 million. Now, the use of these funds is pretty similar, because I mentioned these kind of live under the same umbrella here. But the difference is that you have up to 30 years in terms of the maturity to repay this up to $2 million loan. As far as the interest rate, it's also interesting: 3.75% for small businesses and 2.75% for nonprofits. Now, it's not the lowest interest rate loan in the world, but at the same time, it's a lot lower than you might get from a credit card or taking on some sort of other advance from a bank, things of that nature, bridge loans, what have you. This might very well be cheaper than that. And if you have up to 30 years to pay it, it's not all that bad. On top of that, it's automatically deferred for 12 months in terms of the payments. So you don't have to start making payments for a year once you get the EIDL loan. Now, the amount of the loan that you're going to get is based on credit worthiness. And this means that they're going to pull your credit and establish what you're eligible for and what you have basically the capability to pay back. And the way you apply for it is you go through the SBA website directly. So one of the benefits on this EIDL side is that you don't have to deal with the banks. You go directly to the SBA website, take a look, and you should be able to apply directly. Now, I've had clients reach out to me and said, "Hey, Alex, I went to the SBA website and it says that it's not taking any new applications. What happened?" Now, I'm gonna give you some bad news. Then I'm gonna follow up immediately with some good news. The good news is gonna make the rest of this video worthwhile listening to. So stick around. Don't run away once I give you the bad news, because the good news is gonna follow. You ready? All right. As things stand now, on April 22nd, both this $10 billion for the EIDL program and this $349 billion for Paycheck Protection Program is gone. It's been used up. Don't run away. Don't run away. I said there's going to be good news after the bad news. That's the bad news. The bad news is that all of this money is already appropriated. It's gone, which means that if you go to the SBA website right now, let's take a journey. So SBA COVID-19 loan apply. Let's take a look at what we have. And you'll see this notice come up: lapse in appropriations. It says the SBA is unable to accept new applications at this time for the EIDL program based on available appropriations funding. Applicants who've already submitted their applications will continue to be processed on a first-come, first-served basis. All right. What about the PPP? So we'll open another tab. We'll go SBA, PPP, loan, COVID. Where does that take us? And you'll notice it takes us to the Spanish page. I need to brush up on my Spanish before I can read that, but you will see that on the PPP side, maybe it's not on this page, the funding has also lapsed. All right. And the good news, now I'm going to tell you the good news, is that Senate strikes a deal on $484 billion relief package for small business, hospitals, and testing. That means they're recharging these programs, and they're thinking about it right now. This is April 21st. So Senate is already loving this package. So now the House has to vote on it. President has to sign it. And that will refill these programs to a large extent. Let's take a look at the amounts. So the Senate version of the bill includes $310 billion for PPP. Now, originally, it was $349 billion. That was used up in about 2-3 weeks. Now they're allocating additional $310 billion. Not too shabby, but it's going to go fast because a lot of people know about the program now. Banks have their act together. When this thing first came out, the banks didn't even know what to do. The Treasury Department was saying, the bank's going to be ready on Monday. You can apply. The banks were saying, no. We're not going to be ready. Definitely don't apply. So right now, everybody's had a chance to kind of figure this out, mull this over. There's been new guidance that's come out. Everything's more arranged and straightforward now. So with that being the case, these funds are going to go quickly. That's why I'm doing this video, because now that everything's being recharged, there's not a lot of time to dilly-dally. If you want to take advantage of this, you got to move very quickly. And I'm going to detail why and how a little bit later. Stick around with me. So, $310 billion for PPP, $60 billion set aside for smaller institutions. So, what happened was that it came to light that the big banks were essentially front-loading their larger loans or their existing lending relationships for the PPP loans in front of the smaller mom-and-pop shops, right? Because if you have a client that owes you $100 million and you have the ability to get them this PPP loan, you want to prioritize them, right? You don't want them to go under. You want them to pay your loan. And they've been, if you look at the statistics, it's pretty obvious that that's occurred. Now they're trying to, I guess, spread the wealth a little bit more, and they're talking about this $60 billion for small institutions. Let's see how that plays out. Given that Shake Shack and some other companies that are publicly traded received $10 million, $20 million under this PPP program, I think this is a welcome addition. Let's see how it plays out. So on top of that, they're allocating $50 billion for EIDL loans and $10 billion for EIDL grants. Again, let's go back to the spreadsheet. This total amount before was $10 billion. Now they're adding $50 billion for EIDL, $10 billion for the grant portion, which is that forgivable advance of up to $10,000. It's huge. All right. So it'll open up for a little bit, but I don't expect this to last very long. So if any of this applies to you, if any of this interests you, certainly don't delay, because before we blink, it's all going to be gone. So that's the good news. All right. The bad news was the funds currently ran out. You can't apply for any of these programs at the moment. But as soon as it opens up, you really want to be the first in line if you haven't applied, because this can go very quickly. Once the appropriations run out, they can either refill it like they're talking about doing now, or they may not. And at that point, you would miss out. So certainly something to take into consideration with regard to timing and making sure that if this is something you need, you should certainly look into it. All right, so we have a good kind of general layout of the EIDL side. We talked about PPP very briefly. We're going to go into that a little bit more. And I want to pull up an SBA document. It's a PowerPoint presentation, because literally as soon as I put a presentation together, something changes and something becomes outdated. So I've been going on this rolling basis, updating my PowerPoints. And I said, you know what? Let's just rely on the official guidance. That's going to be the cleanest way to do this. Otherwise, this video would never get made. All right. So this is, let me bring this up so you guys could see it. This is a beautiful PowerPoint presentation put out by the SBA themselves. You could tell they took pride in this document here. All right. So COVID-19 relief for small businesses. And this is going to detail first the EIDL, then the PPP program. We're going to want to understand this a little bit more, become conversant with it, so we can really imagine if this is applicable for our business, not applicable, and go from there. First, I'm going to take a drink of water, and then we're going to dive in. All right. So this part of the presentation refers to the EIDL, the Economic Injury Disaster Loans. Again, we're talking about this area over here. So, very brief overview here. Funds come directly from the U.S. Treasury. which means that you can apply directly for EIDL. No need to deal with the banks. It's a big plus because the banks are playing a lot of games right now on the PPP side. So the fact that you can just pull up the SBA website, go through a quick streamlined application, it's very simple, guys. You've made an application for the loan. It's kind of a beautiful thing. So they put the address here for application. Let's see if it takes us to that same page. Of course, I can't copy and paste this. Disasterloan.sba.gov. All right. Let's see what comes up. Okay. It'll probably tell us that the funds have run out, so don't bother applying. Okay. Yeah, it's not letting us apply directly. Before, there was the link where you can apply directly, and it's going to talk about the fact that the funding has run out. Yeah, there's no link. But that's ordinarily where you'd go to apply for it. So as soon as they announce that the funding has increased, the bill is signed, don't delay. Go to the SBA website on that day. All right. As far as the application cost, there is none. There's no obligation to take the loan if it's offered. So theoretically, you can apply for the loan, see what they offer you, and then take it or leave it. All right. A lot of flexibility here, right? You're not paying anything to apply, no obligation to take the loan. And by the way, even if you don't take the loan, you still get to keep the advance. So if you have a number of employees, that could be $5,000 that you receive that does not have to be paid back, whether or not you take the loan part. So you can see what they offer you, take it or leave it, but you get to keep the advance. All right. The maximum unsecured loan amount is $25,000. So that's kind of a older SBA rule, I believe, Small Business Administration. But you don't have to basically put up any collateral for that $25,000. And the other thing to keep in mind is you don't need a personal guarantee of up to $200,000. So that's another benefit. So there's a tremendous amount of flexibility that they try to impart in these provisions to make sure that it's applicable for as many people as possible and as useful as it can be. So automatically deferred for 12 months. I believe that we have that in our beautiful spreadsheet here. We do. Okay. And the advance of up to $10,000 is available. Again, all of this talk of $10,000 on the dot is incorrect. If you read the bill itself, you'll see that it's an advance not to exceed of or not more than $10,000. So there's a lot of misinformation about that number. A lot of business owners are very upset that they didn't get $10,000. You know, people are struggling. What are you going to do? Now, it says that applicants that have an existing SBA loan number still qualify for EIDL for this disaster, but the loans cannot be consolidated. Okay. So applicants can have an existing, still qualify. So basically what they're saying is if you have an SBA loan from a different disaster, you can qualify for the SBA EIDL under the COVID situation, but you can't consolidate them. Okay, so they'll be kept separate. How much can I borrow? So we talked about under EIDL, you can borrow up to $2 million. The interest rates we touched on, small businesses 3.75, most private nonprofits 2.75. So the majority of people listening probably looking at 3.75%. Terms of up to 30 years. All right, so I mean that's a good amount of time to pay back a loan that you're getting for a disaster that hopefully is relatively short term. We'll see, I guess. And eligibility is based on the size, type, and type of business and financial resources. So when we were first making the spreadsheet together, there was some question about the eligibility terms and how this is determined. Now, it's still a bit unclear how exactly they come up with the amount of the loan that they're going to offer you, the EIDL loan. Rumor has it, through the grapevine, you hear things, that it's half of your annual gross is what they're going to offer you. And what does that mean? So if your business receives $100,000, let's say in 2019, just as the total income amount, we're talking about gross income. And if you're a service business, you don't have cost of goods sold. If you have products that you're selling, you subtract cost of goods sold from that. All right. So it's either your total income, if you're a service-based business, no cost of goods sold. If you have cost of goods sold, you subtract that. You take your annual, you multiply that by 0.5. That's the amount that they're likely going to offer you. All right, roughly. Don't quote me on that, but that's where it comes out. They're not just going to give you up to $2 million per business. That's not going to happen because the funds would run out in 3 seconds instead of 3 weeks. But it's really based on their analysis, and that's a number that they come back to you with. You don't say, okay, I want this much. You give them what your total income is, your cost of goods sold for a year, and then they come back to you with an offer. So an underwriter has to look at that. A loan officer has to evaluate your application, look at the numbers that you entered, check your credit worthiness, and make an offer based on that. All right? All right, so how can you use the funds? These funds are meant to be used for the following purposes. So either you're paying fixed debts, rent, etc., which is interesting because let's take a look at the uses of the funds. On the EIDL side, we determined that you can make rent or mortgage payments. All right, we're not just talking about the interest there. We're talking about the principal, mortgage payments, and the rent payments you can use the EIDL funds for. That's pretty huge, and that's different from the Paycheck Protection Program, which we're going to look at, because it's not as generous. They don't want you spending the PPP funds on the mortgage principal, just the mortgage interest. It's more limited because it's Paycheck Protection Program. That's what they're focusing on, keeping people employed, not paying your mortgage. So that's an important distinction there, whereby if you are on the EIDL side, again, the main word there is disaster. They're trying to provide relief. Overall, it's a bit more general. So it's a wider range of expenses that you can pay with these EIDL funds as opposed to the PPP, which is a bit more restrictive, which we'll get to. We'll get to that. All right. You can pay payroll as well. All right. So if you're getting EIDL and PPP at the same time, you don't want to pay the same expenses you don't want to use the same expenses to justify both programs. Okay. You want to separate it out. So if you plan on getting both, then you may want to use one for Paycheck Protection Program for payroll and the EIDL for some of these other expenses. You don't want to use the same expenses to justify two of these loan programs. That's not going to work in your favor. Accounts payable. All right. So again, the EIDL, the disaster part is saying if you owe money, you can use these funds to pay off those amounts that you owe to vendors and things like that, whereby Paycheck Protection Program is more restrictive. Again, the word paycheck, keep that in mind. And some bills that could have been paid had the disaster not occurred. Again, a bit more general. It says basically, hey, keep your business afloat with these funds, and that's what they can be used for under the program. Now, who is eligible for EIDL? The key term here is under 500 employees. All right, so small businesses, you're eligible. So if you have a corporation, if you have a partnership, if you have a Schedule C that you file, if you're just self-employed and you have just a DBA that you operate under, all of those are eligible. All right. I had some clients reach out to me saying that they heard that, if you have a corporation, you're eligible, but if you're a sole proprietor, you're not. Whether or not you have a business entity, an LLC, this, that, the other thing, doesn't matter. You're eligible. Okay. The question is, where and how are you eligible, right? Because if you have an S corporation, the corporation has to apply for these funds. You can't apply for it directly as the individual. All right. So that's an important point there. Similarly, if you're in a partnership, each of the partners can't apply for the EIDL. The partnership would have to apply for it. So it's based on the business itself. So you got to be careful as to who and why you're applying for it, because that can be a determinative factor of whether or not you get this loan. So the vast majority of my clients will fall into these first few categories: small businesses, sole proprietors. That's where we're going to focus. And there's some other eligibility parameters here that you can take a look at, but generally we're going to focus on those first two categories. All right, so who is ineligible? First category is illegal activities as defined by federal guidelines. If you have a marijuana-based business, you may want to seriously consider the effects of that particular provision, because it may not work in your favor. But it is a question whether, since it's illegal at the federal level, if you'd qualify for this. Secondly, principal with a 50% or higher more in 60 days delinquency on child support. Let's read that one more time. Principal with a 50% more share of the business that's more than 60% delinquent on child support. So if you got that child support, you got to pay. All right. Otherwise, you may have a problem in applying for these loans. Finally, there's some agricultural related limitations. We're going to skip that for now. If you're a business that provides displays of a prurient sexual nature, directly or indirectly, they don't want you in the program. All right. So I don't know if I have any clients that would fall into that category, but I don't know what you people do in your free time. So it's up to you. More than a third of gross annual revenue from legal gambling activities. So even if you went so far as to make your gambling activities legal, you can't have more than a third of annual revenue. Otherwise, you're ineligible. If you're in the business of lobbying, they don't want you here. And if you're a part of Congress, pretty much, or a member of the government. As we talked about, for EIDL, you need an acceptable credit history. They're going to pull your credit. All right. So make sure that if you're applying for EIDL, you don't have a freeze on your credit report. It looks like they use Experian specifically. So TransUnion and Equifax, it doesn't look like they're hitting those up. So if you have those frozen, leave it be. Experian, you want to open that up because that's the company that the SBA is using to pull your credit report. It's going to be a hard inquiry. So it will impact your credit in the short term. So they need to know if you're credit worthy. They're not relying on a lot of information here to make the lending decisions. So with that, they're certainly going to look at if they're going to consider your credit score. They're going to look at if you have delinquent balances and write-offs, collections, things like that. So certainly if you have a rocky credit history, that may impede your ability to receive the EIDL loan. Something to keep in mind. And they also focus on your ability to repay, which coincides with credit history. All right, so there are some ineligible uses of the loan. They don't want you to just get this loan and buy a jet, get this loan, buy an island, and so forth, which was very disappointing to me because I had an island that I was really locked in on. But I read this and I decided definitely not a good idea. So it's not to be used to pay dividends and bonuses, disbursements to owners. Don't confuse that if you're self-employed. Don't get confused there because it's structured to really refer to separate entities or corporations, things like that, paying dividends to their shareholders. That's what it really refers to. If you're self-employed, it's a bit more nuanced than that. And we're going to go into exactly how and why. But for now, let's just go through the list. If there's a repayment of stockholder or principal loans, while there's some exceptions here, in general, not acceptable use of funds. Expansion of facilities or acquisition of fixed assets, which makes sense because they're trying to alleviate, what's the magic word? Disaster implications. So they're not looking to have you buy that new building or build that new capital asset. So definitely avoid that in terms of the use of funds. Repair or replacement of physical damages and refinancing long-term debt. So they don't want you to get this loan at 3.75, refinance the loan that you had at 7%. They saw that coming, so they ruled that out from the get-go. All right, so if you're paying down any other loans and so forth, you want to be careful with using EIDL there. They don't want to pay for your relocation either, so important to think about before you go apply for this, since they are going to pull your credit, what is going to be the use of the funds? Because if you're going to use these funds to buy new camera equipment and upgrade your whole situation, get new microphones and things like that, it's probably not going to fly. And they're going to circle back and they're going to see if anybody's been abusing this program, that I promise you. So careful about that. Make sure you use it for the right reasons. All right. And in terms of applying for it, the application was surprisingly streamlined and straightforward. You went to disasterloan.sba.gov, and this new streamlined application took even the most rudimentary requirements that you think of in applying for a loan and threw them right out the window. You're thinking financial statements, payroll forms, things like that. Nothing. You just go here, you answer a few questions, very simple. Then it asks you what your gross income is for the year, what your cost of goods sold is for a year, and enter this information. This took 5 minutes for most people. Very, very straightforward. I mean, when they say streamlined, they mean it. But one thing that came to light was that the streamlined application may actually require additional information to be provided later on. So whereby initially they had a long form application, which had all of this different info included with it, when they instituted the streamlined application, while it may seem that, they're trying to make this easier, it actually seemed like they might be impeding the process by saying, okay, we don't want any more full applications, so let's put the streamlined application out to try to stem the flow of the applications that we're getting, because now we're going to get essentially incomplete ones. That was what was circulating in the rumor mill, but I do know of clients that went through the streamlined application right around the end of March, and they received their advance payment already, the EIDL advance of $1,000 per employee. It already hit their bank account, and now they're just waiting on how the EIDL loan is going to play out. So when they say streamlined, they mean it. This won't take you any more than 5 minutes once it opens back up. So certainly don't be afraid of the application itself. All right. In terms of the application, the information that they ask you for, it was for the 12 months prior to January 31st, 2020, which is interesting because if you're filing tax returns for 2019, you generally have January 1st to December 31st all ironed out if you filed your return already. But the 12 months prior to January 31st, 2020, you may not have as tidy. So this is an emphasis on why it's important to have great accounting records throughout the year, so that if you have a need for those financials, you could just pull them up easy peasy and it's not an issue. They're going to ask for your gross revenues. That's the total amount that came into the business. If you made 100 grand, it's 100 grand. Okay. Cost of goods sold. If you're a service-based business, you generally would not have cost of goods sold. So it would be more of applicable to if you're selling products on eBay, on Amazon, or if you're a repair business and sometimes you also sell the parts to the customers, that can constitute cost of goods sold. So you would have to reduce the gross revenues by that amount. Now, if you're in the real estate business, you may have some lost rents to take into account. They also want to know that if you're renting properties and you have lost income related to those rental properties, that you definitely want to include that on the application as well. Next item is for nonprofits, not really applicable. Any other reimbursements you'll receive. So if you were lucky enough to actually receive business interruption insurance, which seems like a rarity these days because all these business interruption insurance companies, they have no issue taking your money. That process is streamlined, great, no issue. But when it comes to paying amounts out, they're all trying to scurry away from that responsibility by claiming, oh, well, we don't cover COVID, we don't cover coronavirus. There's a lot of games being played. But if you're lucky enough to be, I guess, the one person that's going to get your business interruption insurance policy to pay out, you want to take that into account and include that on the application. And finally, number of employees, which is confusing because if you're self-employed, do you put 0 since you don't pay any other W-2 employees, or do you put 1 since you're self-employed? It wasn't clear when this application came out. So the way I was looking at it was, look, if you're self-employed and you're paying self-employment tax and you file Schedule SE for self-employment tax, that you put 1. All right. And my clients who have put 1, a number of employees when they're self-employed, got $1,000, which seems to make all the sense in the world. So that's the direction I would take that. Finally, in terms of the advance, they just have a checkbox that asks you, I would like to be considered for the advance of up to $10,000. I don't know why you wouldn't, unless you have really no use for the funds. But if you have business expenses that you could pay for it, I think this is a no-brainer because you get this advance and you don't have to pay it back even if you don't even take the loan. It's huge. So if you have 10 employees, they'll deposit $10,000 into your account that you don't have to pay back, assuming you use it for the right reasons. That's, I feel like, a no-brainer. And you even put your bank account information here, and that really makes everything ready and set up for you to receive the funds. Now, this whole advance funds will be made available within 3 days of a successful application. No, that's not going to happen. That was in the original bill for the CARES Act, but it was well after that amount was paid, even if it was paid. Some people still haven't received their advance. So forget about that 3 days thing. That doesn't apply. And finally, the loan advance will not have to be repaid. It's a grant. So advance, grant, synonymous. Okay, so in terms of the information that's requested for the EIDL loan itself, you may be looking at providing some more information in terms of what the amount is that they should offer you. But from what I've been hearing, they will look at your creditworthiness and make an offer based on the information you included on the streamlined application. They don't ask for additional information from what I've heard, okay? Clients basically go from the application to getting the grant to then getting the offer from the SBA for what their loan is going to look like. So a little bit more about the process. Once you submit that streamlined application, what we're seeing is clients will get that advance payment in their account. So $3,000, $5,000, whatever. And you know that is from the SBA because it'll say that in the description of the transaction on your bank statement. All right. So you look at your bank activity, you see that $1,000, $5,000, $8,000 come through. You know that's the advance. It's a nice round number. Okay. So once that's paid, it becomes a bit of a waiting game because you don't really get anything from the SBA signifying, hey, you know, we're working on your loan. It's still all kind of up in the air at that point. Now, the important thing is when you apply for this thing, they're going to give you an application number. You want to save that page for the EIDL because you're going to need to reference it later on if you need to call the SBA to follow up on the status of your application. But generally, after the advance is received, the next step is you should receive an email from the SBA welcoming you to the portal. All right. The portal is where the magic happens for the loan portion, for this portion of the EIDL. All right. Until you get that link, you cannot accept or even see the offer amount that they're giving you on the EIDL side. So it's a bit of a waiting game for a lot of business owners right now. Some of them have not received their advance and have not received that email. Some of them have received their advance, but have not received that email. So at this point, that's the next step. And the idea is you can call the SBA and you can ask them what the status is, and they might be able to give you some insight on that. But you have to understand that even clients who've gotten quote unquote approved, meaning that they got an offer, they accepted the offer, they were later denied the loan. So it's a bit of a mess how the thing is structured right now because they received that portal link. They're offered $50,000. There's a slider. You accept the $50,000. It goes back to the SBA and they deny it, which sounds crazy, right? Why did they offer me $50,000 if they're getting ready to deny me? It's unknown. Right now, it's a complete mess in terms of how it's being implemented. This was a rush job from the very beginning. With that said, there are businesses that are actually getting to the funding stage of the EIDL to where they accept it. They get that slider, put it all the way to the top or wherever they need. They send it back to the SBA and boom, funds hit their account. It could be $30,000, $50,000, what have you. But this is real and it does work for a lot of clients out there. But some clients are getting denied that have fairly high credit scores. So it's not exactly clear what they're basing their decisions on. But that's the timeline. Okay, so you go from the application. The first step is generally they deposit that advance up to $10,000. Then the next step is really a waiting game. And you can call the SBA, but you got to keep in mind that if you do call them, they're going to, the first person to answer is known as Tier 1. All right. They're great people, I'm sure. But to be honest with you, they know nothing about your loan. A lot of times their job is to serve as the kind of frontline person just to tell you, hey, just keep waiting. Everything's great and dandy. But I've actually had a Tier 1 person tell me they can't look up my loan. And I say, how is it possible that you at the SBA can't look up my loan that the SBA has put together? The application number is here. What's the deal? And they said, let me transfer you to Tier 2. Now the Tier 2 people, they know what's going on, and they can actually pull up your information. So if you're calling SBA and you get just the first person to answer the phone, the first words that you should say, transfer me please to Tier 2. And typically they'll do so without too much of a fight. And at that point, you can actually see what you're eligible for, kind of the where you are in the process. It's not going to guarantee that they're going to tell you, oh, you're eligible for XYZ. Here's your portal link. But at the very least, you can say, okay, well, are we still moving? What's the status? And they should be able to tell you. Whereas Tier 1, I'm sure they're great people, but they know nothing. All right? So at the end of this, I'm going to try to pull up the link. I'm going to write this down. to the phone number to the SBA. So I can give that to you guys so you can follow up on your loan once you've applied, once they open it back up. And again, tier 2, tier 1, they know nothing. Nice people, but they don't know much about your situation. Okay, so they also say that there's some additional documents that could be requested. Right now, for the EIDL, I'm just seeing that they're pulling credit and basing the decision on that. I'm not seeing that they're really requesting a lot of this other stuff, but they might. So you don't want to really make up any numbers over here. Make sure that you provide the right information. All right, so now we have some general info. Okay. All right, so that pretty much gives us a rough overview of the EIDL. If you guys have questions, drop them in the chat below. I'll try to address those as well as we go through here, because right now we're very heavily going to focus on PPP. So if you have some EIDL questions, now is probably a good time to get those out. So we're going to delve into the Paycheck Protection Program. And again, what's the key word that we're going to focus on while I take a drink of my tea? It's definitely paycheck. All right, so if you said paycheck, you're right. Give yourself a point. Okay, so Paycheck Protection Program. This one's a little bit more complicated, all right? Now we're moving on to this area. This one's a little bit more intricate, a little bit more nuanced, but take a look at this part. Loans are given up to maximum of the lesser of $10 million or 2.5 times average monthly payroll costs. Now, this gets a lot deeper in terms of definitions, details, and so forth, but just keep in mind for now that we're talking about this area and we're focusing on those paychecks, but specifically 8 weeks of payroll costs. That's what it's geared for. And we're going to see how that applies and how that works, but just keep that in mind, 8 weeks. Funds can be used to pay interest on mortgages, rent, and utilities. So this is one of those distinctions, very important, between PPP and the EIDL. We just saw here interest on mortgages or rent. The EIDL is rent or mortgage payments, okay? So it's more flexible, it's broader on the EIDL side in terms of how you can use the funds. On the PPP side, again, it's geared towards payroll. That's the first item. They're not too excited about you using it for another purpose. So definitely you need to keep in mind that this is geared for those paychecks. I can't emphasize that enough. One of the benefits also is that the entire loan amount may be forgiven on the PPP side. All right? So theoretically, you can have a $10 million loan that you don't have to pay back. It turns into essentially a grant for all intents and purposes. The stipulation is how the funds are used, the timelines. There's a whole set of criteria there. But it's important to keep in mind because this EIDL, as great as it might be, it's based on credit, streamline, all that good stuff. Check this out. You got a big no on the forgiveness side. So you're stuck with that amount as a loan at 3.75% for small businesses up to 30 years. Whereas on the Paycheck Protection Program side, if you're using it primarily for payroll, then you might have the whole amount forgiven. So this is why this one is so interesting, because there's the ability to really not have to pay back a good portion of this bad boy. So that's certainly something to keep in mind. All right. Total loan amount up to $10 million. That's reflected in our spreadsheet here. Must be small business. Again, the 500 employee threshold holds true here. Notice that sole proprietors, self-employed individuals, and independent contractors are included in that. All right. So you don't have to have a corporation, don't have to have a partnership. You could just be self-employed individual with or without a DBA. You're good. So in terms of the start dates, you'll see that they were kind of staggered. So self-employed individuals were able to start applying later, meaning by April 10th, whereas everyone else, all the other small businesses, were able to apply by April 3rd. Was that fair? Not fair? Hey, we could debate. But those are the dates that were applicable. Now, who knows what's going to happen, because once they release the new bill, these dates will obviously need to be pushed up. So that's something to keep in mind in terms of when, based on the type of business you have, you're eligible to apply for this stuff. And finally, the way everything is structured right now, PPP is available until June 30th. So that's really the cutoff for where these funds may be dispersed. That may be adjusted now, given that we're a little bit further into the process in terms of this CARES Act, but it's available until June 30th as things stand now. I anticipate that that's going to change as well. So these dates, take them with a grain of salt because there may be updates in this area. All right. So as I mentioned with the PPP, the primary focus needs to be on that payroll. Now, what does that mean, payroll? Okay, there's some nuances there. Now, it also says 75%, and what they're saying there is at least 75% of the funds that you expect to have forgiven need to be used for payroll, all right? If you use 100% for payroll, then you're gravy because you used 100%. But if you use less than 100%, then you may have an issue in terms of how much is going to be forgiven and how much you're going to have to pay back. And again, it's over the 8 weeks following the origination of the loan. So they're saying you get the loan. You need to start paying those payroll costs, all right, for the next 8 weeks. And if you pay 100% of those amounts for payroll, you can have that amount forgiven. This is big, all right, because that number could be $10 million. So what constitutes payroll costs? As simple as that term may seem, it has fluctuated, the definition, since the CARES Act was signed. There's some guidance that was put out that you'll see that this definition kind of morphed over time. But let's see what the SBA's take is on this. This is as of, let's see here, I believe this came out on April, let's see if there's a date. I believe this came out on April 4th. But again, don't quote me on that. All right. So it's referring to salaries, wages, commissions, and tips capped at $100,000 per employee. All right, so what does that mean? They're not saying that if you have an employee that makes $105,000 that employee is eliminated. That's not the point. The point is the $100,000 is a cutoff. All right, and what it means is that if you have 5 employees and you pay each of them $500,000 a year, then in terms of considering payroll costs for PPP purposes, you can only take into account the first $100,000 for each of those employees. All right. So this really means for this to be used for individuals who aren't, attorneys pulling in $700,000 a year. Those firms can still use these programs, but they're not going to get as much of those payroll costs included in this category because the vast majority of their payroll is over that $100,000. Finally, employee benefits, including costs for vacation, parental, family, medical, or sick leave, are included in the definition of payroll costs. So again, that increases the amounts that you can possibly have forgiven if those are the amounts that you're paying. So this is good. It widens the net for the amount that you can basically not have to pay back. State and local taxes assessed on compensation. Most will use average monthly payroll in 2019. So being the fact that this program was rolled out in such a haphazard manner, one thing that happened is there was disagreement between the SBA and then the actual banks in terms of which period to use. So we'll come back to that in a little bit. But for sole proprietors, it's wages, commissions, income, or net earnings from self-employment capped at $100,000, right? Because if you're self-employed, you're not paying wages to yourself. You're just working with the flow through from your Schedule C or the net income from your Schedule C. So with that said, you don't have to pay yourself a W-2. You don't have to really do much at all except have net earnings from self-employment. So if you have negative amount resulting on Schedule C, then you don't have net earnings from self-employment. It needs to be a positive number, and it's capped at $100,000. All right? For seasonal businesses, you can use your average monthly payroll costs between February 15th and June 30th. I don't know why they picked that time period, but that's what it is. Again, capped at the $100,000. And if you're a new business, your average monthly payroll costs from January 1st to February 29th, capped at $100,000. All right. So other eligible costs, and this could represent up to 25% of the amount that you can possibly have forgiven under Paycheck Protection. You can use it for rent under lease agreements, utilities, interest on mortgage obligations, not the principal, and interest on any other debt obligations that were incurred before February 15th. They don't want you taking on new debt and paying the interest. This is for old debt that existed already before that February 15th date. So, a bit more detail on payroll costs. Now, when this bill first came out, the CARES Act had information in it, and the SBA interpreted that information as follows. They released an interim rule on April 2nd, and their goal was to provide some clarification in terms of what's included in payroll costs, what's not included. Business owners were asking. I mean, I have retirement contributions, we have FICA, we have all these different costs that constitute payroll. What do we include? What do we exclude? Great questions. So the SBA came out, so we're going to clarify for this for you guys. Don't worry at all. All right. So in terms of, and I'm going to include a link for this document. You can find it on the SBA website. Let me dig this up for you guys. All right. So you can find this information right here. Let me just verify this is the right link. Okay, so this is a great page for getting PPP information. So specifically, we're looking at information in terms of the program rules. So a lot of these documents that we're checking out right now, you can find them right here. I'm going to put that link in the chat. Okay. Are we having fun, guys? I'm having fun. I know I'm enjoying this right now. So back to the document. It says, and this is for PPP. This is SBA guidance. How do I calculate the maximum amount I can borrow? The following methodology, which is one of the methodologies contained in the Act, may be useful for many applicants. First step, aggregate payroll costs as defined in F. Let's take a look at F. And guys, if you're thinking about taking the PPP loan and you haven't read these documents right here, you're doing yourself a tremendous disservice because they're written in plain English. They're very understandable, and they'll give you a good knowledge base in terms of making the decision as to whether or not this is useful for you and the extent that it would be. So taking a look, it says, what qualifies as payroll costs? This is from April 2nd. All right. The bill was signed, CARES Act, on March 27th. This is from April 2nd. The information that I'm about to read to you is wrong. And we're going to see how they corrected it. So don't listen to this and then run off and use the information. This, based on the guidance now, is incorrect. So it says payroll costs consist of compensation to employees whose principal place of residence is in the United States in the form of salary, wages, commissions, or similar compensation, cash tips or the equivalent based on the employer record of past tips or in absence of such records, a reasonable good faith employer estimate of such tips, payment for vacation, parental, family, or sick leave, medical leave as well, allowance for separation or dismissal, so on and so forth. Importantly, it says the payment of state and local taxes and net earnings for self-employment. So far, so good. Now, it goes on to say, is there anything that is expressly excluded from the definition of payroll costs, right? Because if you're an employer, you know you're paying for the retirement plan contributions, you're paying FICA, you're paying unemployment tax, you're paying all of this other stuff in addition to the payroll costs themselves. So it says, yes, the Act expressly excludes the following. 1, any compensation of an employee whose principal place of residence is outside of the United States. The compensation of an individual employee in excess of the annual salary of $100,000 prorated as necessary. We talked about that limitation. Here's the crucial one. Federal employment taxes imposed or withheld between February 15th and June 30th, including the employee's and employer's share of FICA. So what they're saying is that, let's say you pay an employee $4,000, right? And $500 of that is what's withheld from their paychecks for FICA. And you, as the employer, have to add another $500. Based on this, you have to subtract from payroll costs the employer portion, which now from a total of $4,500, you're back at $4,000 in terms of the payroll cost. Then you also have to subtract the employee's contribution to FICA, another $500 off. So now, from paying $4,500, your payroll costs based on this paragraph are $3,500. because we took away the employer's contribution to FICA and the employee's contribution. So when this came out, everybody's like, what is going on with this? Because it makes no sense. It makes no sense. This was released on April 2nd, 2020. So then what happened? They released another, and by the way, this is the first interim final rule. Then they released another part of the interim final rule. So the interim final rules keep coming, ladies and gentlemen. They also released a frequently asked questions page that we're going to take a look at. Now, this is on April 17th, 2020. Check this out. So we go down here. Now, the question is, how should a borrower account for federal taxes when determining its payroll costs for purposes of the maximum loan amount, allowable uses of a PPP loan, and the amount of loan that may be forgiven? It says, under the Act, payroll costs are calculated on a gross basis without regard, i.e. not including subtractions or additions based on federal taxes imposed or withheld, such as the employees' and employers' share of FICA and income taxes required to be withheld from employees. As a result, payroll costs are not reduced by taxes imposed on an employee and required to be withheld by the employer. But payroll costs do not include the employer's share of payroll tax. Now, I've read this many times, and it seems to directly contradict what the SBA said right here, because it says, is there anything that is expressly excluded? Yes, the Act expressly excludes the following, and they say here, including the employee and employer's portion of FICA. So very quickly, you could see how this program is changing, right? So they give us an example. For example, an employee who earned $4,000 per month in gross wages, from which $500 in federal taxes was withheld, would count as $4,000 in payroll costs, which contradicts what they said 2 weeks earlier. But this is what it is. The employee would receive $3,500, and $500 would be paid to the federal government. However, the employer side federal payroll taxes imposed on the $4,000 in wages are excluded from payroll costs under the statute. So it's kind of strange that as the employer, you feel the pain of paying those employer portion of payroll costs, but they're not included in terms of PPP as payroll costs. And just to, they include this kind of cockamamie explanation as to how they interpreted the bill and how they came up with this new perspective. I can't piece this together for the life of me. It looks like they're just sidestepping the fact that, hey, we goofed this. But hey, right now, the important part is that for payroll costs under the PPP, you need to consider that the employer portion of FICA, not included. There are some state taxes that are the employer portion that may be included, but FICA is not. So when you're calculating payroll costs, you need to exclude the employer portion of FICA. You can include that. You don't need to adjust the wages for the employee portion. That's what that's saying. That's a key thing. And this caused a lot of confusion because between April 2nd, when this guidance was put out, and April 17th, when this was put out, a lot of applications were filed. Probably incorrectly, given the newest guidance. I mean, on the good side of things is that you can rely on the guidance that's put out at the time when you make the application. So it doesn't look like this would be retroactively effective, thankfully. But this is the latest and greatest with regard to how you calculate the payroll cost. Now, why is that important? I do want to outline that because I don't know if I've stressed this enough. But payroll costs under the PPP have three distinct applications. Firstly, you need to determine it for purposes of the maximum loan amount. Okay, so right at the beginning, and this is what this says here. So loans are given up to maximum. So this is the total amount of PPP that you may be eligible for, given up to a maximum of the lesser of $10 million or 2.5 times the average monthly payroll cost. That's the term there. That's what we're talking about here, how to determine the payroll cost. And one of the applications of that under PPP is determining the maximum loan amount, period. So before even anything else, before we talk about forgiveness, before we talk about this, that, or the other, we're talking about what total loan amount you'd be eligible for. And this is important because you, as the business owner, have to calculate this. Whereas the other application is pretty straightforward. They don't really ask you for much. Here, you have to get into the nitty-gritty details in determining what your amount is that you're applying for, because you need to tell them this amount. All right. And some lenders have put out little calculators, little Excel forms to kind of help in this regard. But really, it's a matter of digging into the payroll and seeing what those costs are, because you want to be very clear that you're applying for the right amounts. All right. Because you can very easily end up in a situation where you calculate that improperly and you could get yourself in trouble. And apologies for the background noise. I usually record videos at 2 or 3 in the morning because other than that, the neighborhood I'm in sounds like a complete jungle. And we're seeing that today because it's actually daylight. So pardon me, but we'll get through this. The show must go on, as the great Freddie Mercury once said. All right. Okay. So that's the first application, the maximum loan amount. That's what we have to figure out. Then there's the allowable uses of the PPP loan, because they want you to use this primarily for the payment of those payroll costs. And you also need to consider the fact that for the forgivable amount, there are some adjustments that would be made there in terms of figuring out exactly what's forgiven and what's not. So crucial to understand payroll costs. Now, the U.S. Chamber of Commerce released a good document here that I'm going to post a link to so you guys can check that out. And it provides a little bit more information in terms of how this all plays out and what payroll costs are all about in terms of PPP. All right, so we scroll through here. I put the link in the chat for you guys. Let's look at some of these requirements just to reiterate our understanding. So am I eligible? This is for PPP. Small business with 500 or fewer employees. You have, let's see, small business with, okay, so these are some additional requirements. Let's see, a small business with tangible net worth up to 15 million, average net worth for the last 2 fiscal years prior to application does not exceed 5 million. I honestly have not seen that requirement before, so I'm not sure where the U.S. Chamber of Commerce got that. So that's something we're going to need to verify. But other than that, you typically have the 500 or fewer employees rule being applicable. So scroll through here, and it has a good breakdown of all of the payroll cost calculations that could make their way into the PPP program. Now, this gets very nuanced, okay? So it's helpful if you're working on this to interface with your accountant, get them into the loop and have them help you with this, right? Because you want to know exactly what the time periods are, what the averages are, and if you don't calculate this correctly, it could be a problem because you would apply for an incorrect amount. So very straightforward. The payroll costs, average monthly payroll costs, are the sum of included payroll costs minus the sum of excluded payroll costs equals payroll costs. All right, it's pretty straightforward there. And again, why do we care about average monthly payroll costs? It all ties back to determining what that amount even is that you're eligible for. So 2.5 times the average monthly payroll cost is the maximum that you're eligible for, that or 10 million, whichever is higher, or whichever is lower, rather. So that's why you need to take this seriously. Included in payroll costs for employers, we talked about salaries, wages, commissions that you pay to your employees, payments of cash tips, all those sorts of medical and family leave, allowance for dismissal or separation, and payment of state or local taxes assessed on the compensation of an employee. So we talked about FICA, the employer portion, not counted in terms of payroll costs for PPP. The employee portion, you don't have to adjust the payroll costs for that. But the state and local employee taxes that you pay generally are included in terms of payroll costs. And for sole proprietors, independent contractors, and self-employed individuals, the net income of not more than $100,000 in 1 year. So even if you don't have any employees that receive a W-2 in particular, you can still qualify for this, and you need to make the calculations accordingly. Now, in terms of the excluded payroll costs, you have the compensation of an individual employee in excess of an annual salary of $100,000. We talked about that. And it says here, employer contributions to healthcare and retirement benefits are not part of the amount deemed in excess of $100,000 salary. So this is where you're getting into the technical details here. The employer portion of payroll taxes, not included. Any compensation of employee principal place of residence outside the U.S., fine. And then qualified sick leave wages for which you receive a credit. So they're talking about you can't double dip on the amounts that you're getting taken care of by the PPP and the amounts you're getting employment credits for and things of that nature. Now, one of the stipulations of the, again, Paycheck Protection Program is that you don't just fire everybody, keep the money, and go to Barbados and never be seen again. They want you to maintain both the number of employees, and they don't want you to reduce their salaries either by an excessive amount. So that's why these two calculations here that are featured in this spreadsheet or this presentation are very important, because this can reduce the amount that you have forgiven. So if you get the loan and you fire everyone, bad news bears, because that's going to affect directly the amount of the loan that you have forgivable. Similarly, if you keep everybody on payroll, but you cut their compensation in half, assuming they're under $100,000 to start in terms of their compensation, that's also going to affect the amount that you have forgiven. Now, this is where this thing gets very technical and sort of complex and involved. So I'm not trying to get too deep in here into the weeds. I just want to give you guys a little bit of an idea of the things that would come into play here, the variables, and then you can really take it from there once you discuss this with your accountant, your CPA, and really get the calculations fine-tuned. So in very general terms, payroll costs calculated on page 2. What are we talking about? Page 2. We talked about those included payroll minus excluded is the payroll cost. So that's what we're talking about there. Times the average number of full-time employees, let's call them FTEs from now on, per month for the 8 weeks beginning on loan origination. Again, there's that 8 weeks. All right. So once you get the loan, the next 2 months or the next 8 weeks, essentially, that's going to be determinative in terms of the average number of full-time equivalent employees. That's the time period that they're going to look at for this variable right here. Okay, so it's payroll costs calculated on page 2 times this number, all right, divided by, and here you have some options, which is sort of interesting, and you may be able to figure out which one's most advantageous and use that to your situation. This is where getting a professional involved would pay off, because they can try to optimize this for you. Option 1 is average number of full-time employees per month from February 15th to June 30th, or average number of full-time employees per month from January 1st, 2020 to February 29th, 2020. Or for seasonal employers, average number of full-time employees per month from February 15th, 2019 to June 30th, 2019. Okay, so if you have a seasonal business, that's the time period you'd use. I have no idea how they got these dates, but that's what it is. So they don't want you to reduce the number of employees. If you're self-employed, this kind of takes care of itself, because you are not going to fire yourself theoretically. So you would start with one full-time employee, let's say, if you don't employ anybody else, and you would end the period full-time employee. So it'd be one either way. So you wouldn't have a reduction. What they're trying to avoid here is a reduction in the number of employees. So if you reduce the number of employees that you have, that may affect the amount that you have forgiven. So similarly, if you reduce the wages, and you basically have a different calculation to worry about, and these work concurrently. You can't choose one or the other, see which one works better for you. You have to consider both of these, all right? So they don't want you firing people. They don't want you to reduce their pay, and we'll look at how that works. For any employee who did not earn during any pay period in 2019 wages at an annualized rate of more than $100,000, the amount of any reduction in wages that is greater than 25% compared to their most recent full quarter. Again, it gets kind of technical. This is why I didn't want to get into too much specifics, but in very general terms, if someone makes $1 million in wages and you cut their pay by 50%, that is not going to affect this calculation, because all of those numbers are over 100,000. But if you have someone that falls into the category, and let's say they make 75,000 in a particular year, and you cut their wages by more than 25%, that's going to affect the amount that you have forgiven. So both of these considerations work concurrently. You can't choose one or the other. You have some options here, but in general, these are the considerations you need to take into account to determine what portion of the loan that you get under PPP that may be forgiven, all right? Because the goal is to not have to pay it back, ideally. But those are the parameters. So that's why, in terms of payroll costs, you need to consider it for 2.5 times monthly payroll costs to determine what amount you're eligible for. Then you need to determine it for the amounts that may be forgiven. And the other stipulation, of course, we talked about is not more than 25% of the forgiven amount may be for non-payroll costs. So that goes back to that 75% rule that we saw in this presentation, other eligible costs, right? So we talked about payroll costs for those 8 weeks. 75% of that at least has to be for those payroll costs. And 25% at most can be for other non-payroll expenses. So you talk about your rent, you're talking about mortgage interest, things like that. If you fall outside those parameters, that may affect the amount that's forgiven ultimately, all right? So they need it to be mostly for payroll costs. Then you also need to take into account that alongside that rule, that you can't reduce the number of employees significantly. And because if the average number of full-time employees drops, if this number goes down, you may have an issue there. And then it's also concurrent with the reduction in salaries. If you have those employees that make less than $100,000 and you drop them more than 25%, that's yet another issue. So there's kind of a few landmines here, and this is where it can get tricky. But certainly you want to make sure that you're taking all of those things into account, because that's going to determine what you're going to look like once you make it out of this thing. And the goal is to, if you take this amount and you don't fire anybody and you use it for the right purposes, then theoretically you can get up to 2.5 times of your average monthly payroll costs forgiven. But all of these calculations need to be done carefully. I can go on for hours on the details of how they're done and what to include, what not to include. But I want to give you guys a general understanding. I don't want to completely bore everybody to death. So if you're still with me, leave a comment. Let me know you're out there. Like the video, share the video, whatever you have to do. Because right now, we're going to keep on trucking and get some more details on this. So I think we're done with this frequently asked questions, and we are. Now we're going to move on to a bit more clarification from the SBA, because they've kept releasing updates in terms of how this applies and how you need to navigate this program. So looked at the frequently asked questions. Again, all of these documents are on that SBA or the Treasury website that I linked earlier. All right, so here's a few key points that I wanted to outline. All right, so let's see here. They also released some clarifications in saying that if you have a partnership, each of the partners cannot apply individually for PPP. You need to apply for it at the partnership level, all right? So it's not that you can have 5 partners, each one applies. It's not going to work. You apply for it at the partnership level, and you determine the payroll costs up to $100,000 annualized that's paid to each of the general partners who are active in the business. All right. So if you have 3 partners, they're all in an LLC, they're all working for the business, then you take into account as those payroll costs up to $100,000 of their self-employment income. All right. So that's how it's handled for partnerships. If you have an S corporation, then you take into account your wages at the S corporation level. The distributions don't count. So you can't look at, oh, well, I had $25,000 salary, I've had $25,000 distributions, that's $50,000 in payroll costs. It's not. You just basically start with the $25,000 that's on the W-2 for S corporations. All right, so furthermore, there's other details here that are interesting. And now we're going to talk about sole proprietors, because there was a question of how to apply this for self-employed people. So which number do you take off the tax return? Because some deductions for self-employed individuals happen on the front of the 1040. So if you're making retirement plan contributions, self-employed health premiums, those are all adjustments to arrive at AGI. They don't happen on Schedule C. Let's pull up Schedule C here, because we're going to talk about self-employed individuals. So you Google it just like that. Let's pull up good old Schedule C, one of my favorites. All right, so if you're a sole proprietor, you're operating under DBA, or you have a single member LLC, you're dealing with Schedule C. So let's see how this applies in that context. Now, In terms of retirement plan contributions and things like that, you don't find any of that here, because unless you're contributing for your employees as a self-employed individual for who you issue a W-2, you won't see any of that here. Similarly, self-employed health insurance premiums, they don't apply anywhere here. So the question is, which numbers do we take? How do we calculate this for self-employed individuals in terms of the PPP program? What are payroll costs? They provided some guidance. How do I calculate the maximum amount I can borrow and what documentation is required? So for self-employed individuals, it says how to calculate your maximum loan amount depends on whether or not you employ other individuals. If you have no employees, the following methodology should be used. Now we're talking about practical application. Step 1, find your 2019 IRS Form 1040 Schedule C, line 31 net profit amount. And looking at Schedule C, we just happen to notice that line 31 is this profit number, which you guys can't see. Let me adjust this. All right. Line 31, they're talking about on Schedule C, net profit or loss. All right, so that's really going to be the focus of this part of the provision. Now, find your 2019 IRS Form 1040 Schedule C, net profit amount. If you have not filed a 2019 return, this is interesting. You fill it out and compute the value. So it's saying if you haven't filed your return, pull out that Schedule C anyway. That's what they want to see. That's the document that they're going to consider to determine the maximum loan amount. If this amount is over $100,000, reduce it to $100,000, because we talked about that cutoff already. That's still certainly applicable. That $100,000 is pretty much going to follow you throughout this whole Paycheck Protection Program situation. So don't forget that. If the amount is zero or less, you are not eligible for a PPP loan. So we talked about that. If you have negative self-employment income, then that doesn't provide eligibility in terms of this program. Then you calculate the average monthly net profit amount. Divide the amount from step 1 by 12. You can do that. Then you multiply the average monthly net profit amount from step 2 by 2.5. Everybody on this webcast can follow that so far. And you finally add the outstanding amount of any EIDL loan made between January 31st and April 3rd that you seek to refinance, less the amount of any advance. So what they're saying is, if you get both the EIDL and the PPP, because you can apply for both, and you end up using the EIDL portion for payroll, then you may need to consolidate or refinance that amount as a PPP loan. Okay? So it would be essentially added to your loan balance on the PPP side, less the amount for the grant. So that advanced portion that does not have to be repaid, you don't add that. But if you got a $50,000 EIDL loan that you want to use for payroll, then you get the Paycheck Protection Program approved, then you would need to refinance that as part of the PPP loan. So if it was made between these dates and you seek to refinance, that's another consideration you need to take into account. And again, it's a little technical how that part works. You want to just make sure that you approach that correctly. There's some details there, but in general terms, that's how that works. So regardless of, let's see here, let's pull up this portion of the information. Regardless of whether you have filed a 2019 tax return with the IRS, you must provide the 2019 Form 1040 Schedule C with your PPP loan application to substantiate the applied for PPP loan amount, and a 2019 Form 1099 Miscellaneous detailing non-employee compensation, Box 7, invoice, bank statement, or book of record that establishes that you are self-employed. Now we're getting into the details, and they're saying, hey, we want some solid documentation. We don't want just the scribble-scrabbles that you guys put together on the notepad. We want a Schedule C. This emphasizes the importance of having your accounting in order throughout the year. Aside from that, it says you must provide a 2020 invoice, bank statement, or book of record to establish you were in operation on or around February 15, 2020. If you have employees, the following methodology should be used. And you guys can browse through here. This is all from this Treasury website right here. So you can take a look at these documents and work through that. I'm not going to go through it on the call here. But that's where some of the amounts are coming from. So we have a little bit of an idea there, and it takes into account the 941s that are filed for payroll and so forth. It tells you how to adjust those. Okay. So it asks, how can PPP loans be used by individuals from self-employment who file a 2019 Form Schedule C? The proceeds of the loan are to be used for the following: owner compensation replacement, calculated based on 2019 net profit as described above. We already talked about that. Employee payroll costs as defined in the first PPP interim rule. We talked about that as well. But we also determined that for W-2 employees, the employer portion of FICA isn't covered. And you'll see that for self-employed individuals, it's not considered as well, because if you look at net profit from self-employment on Schedule C, this amount does not consider any self-employment taxes that you paid. So it's really based on line 31 of Schedule C. That's the operative amount for our purposes here. All right, so PPP loans can be used for mortgage interest payments, but not mortgage prepayments or principal payments. Again, that's another difference from the EIDL side of things that allows for principal payments on any business mortgage obligation, not personal, on real or personal property. Personal here refers to non-real, but it still has to be tied to your business. Don't get confused there that, you can write off your chihuahua over here. So, so mortgage interest payments, but not mortgage principal. I've been doing this for how long now? I'm getting a little loopy, guys. We're an hour 25 into it. I can make some silly jokes, right? Okay. So more on the refinancing of the EIDL and the PPP and how that works. So refinancing an SBA EIDL loan made between January 31st, 2020 and April 3rd, 2020. If you received an SBA EIDL loan from January 31st to April 3rd, 2020, you can apply for a PPP loan. If your EIDL loan was not used for payroll costs, it does not affect your eligibility for a PPP loan. Okay, they can coexist, but you need to use them for separate purposes. If you get the PPP or you intend to get the PPP, then you should certainly set aside the payroll costs to be paid with those funds. If you're getting the EIDL, use that for other purposes. You want to maximize what word for the PPP? Paycheck, all right? You definitely want to emphasize that because that's going to be determinative as to how much of that is forgiven. On the other side, on the EIDL side, you would be allowed to use it for certain purposes. It wouldn't be forgiven, but it's important to separate the two because otherwise, here's what happens. If your EIDL loan was used for payroll costs, your PPP loan must be used to refinance your EIDL loan. Proceeds from any advances will be deducted from loan forgiveness. So basically what it's saying is, if you use the EIDL for payroll costs, your PPP loan will include that now. So your EIDL will basically be refinanced as a PPP loan. The interesting thing is, going back to the very beginning, now from a term of 30 years from the EIDL side, your loan amount now became 2 years. Your loan maturity date now became 2 years, from 30 to 2. All right, so it's important to take that into account in terms of how you're going to structure this, right? If you're going to have both, you want to use them for different purposes. Focus the PPP funds on payroll and spend the majority of those funds on that, at least 75% on payroll. That you're looking good on that side. The EIDL, you want to use for those other expenses. You can use mortgage payments, your rent payments, leases, things like that. So all the things outlined here. So that's how these programs can be coordinated. You can apply for both, but you're going to get the best end result if you use them for separate purposes and focus the PPP side on payroll costs. Again, we get to that word payroll costs. That's why I'm emphasizing it so much. But that's how those programs interact. All right. So let's see if there's anything else here. Another interesting thing. So self-employed individuals, if you have a Schedule C, you well know the situation, right? Because in general, service-based Schedule C businesses, not all of them, but a lot of them don't have a lot of fixed costs, right? Some of them work from home. You work from your car. You don't have maybe a mortgage. You don't have a huge office, lease expenses, things like that. You don't have a lot of capital funds that you need to shell out on a monthly basis. You basically have more flexibility in terms of, oh, well, I'll defer my payments to next month, or I won't invest as much in my business this month, or I'll make my repairs later in the year as opposed to earlier. You have some leeway. So what the SBA realized was they said, hey, if we're letting self-employed individuals have leeway in terms of how they're structuring their net compensation and this and that, then they can very well inflate artificially the 8 weeks right after the origination of the PPP loan, right? Because they could just say, I'm just not going to pay a lot of expenses in those 2 months. Or I can ask my clients to not pay me until that particular point. So if you owe me from March, listen, don't pay me in March. You can pay me after this loan originates, right? So you have some flexibility in terms of the payments, and there could be some shenanigans that are played by business owners here. So this is kind of interesting. It says the administrator, in consultation with the secretary, has determined that it is appropriate to limit the forgiveness of owner compensation replacement to individuals with self-employment income who file Schedule C to 8 weeks worth, 8 divided by 52 of 2019 net profit. This is most consistent with the structure of the act and will prevent windfalls that Congress did not intend. Because theoretically, if we're looking at Schedule C, line 31, you have some leeway here because look at all the variables, right? You have all the income that's variable. I'm not trying to provide a manual on how to skirt the system, okay? Don't get the wrong idea. But in general, you can have flexibility over income. You can tell clients that, hey, you can space out the payments a little bit, or you can prepay, right? I don't know how much traction you get with that right now, but in general, there's some flexibility there. On the other hand, you have flexibility in terms of expenses. You can say, listen, I'm not going to pay some advertising expenses right now. I'm going to pay them later. Or the insurance payments, I'll prepay them, and I won't have to worry about them during the 8-week period. So there's a lot of games that can be played here. So SBA realized this and said, no. We're not just going to let you do whatever you want for those 8 weeks following loan origination and then claim that as the net earnings from self-employment, meaning that everything is forgiven. That's not what they're looking for. They say Congress did not want that. We don't want that. And no bueno, as they say in German. Now, Congress determined that the maximum loan amount is based on 2.5 months of the borrower's payroll during the 1-year period preceding the loan. Congress also determined that the maximum amount of loan forgiveness is based on the borrower's eligible payments, i.e. the sum of payroll costs and certain overhead expenses. For individuals with self-employment income who file Schedule C, the administrator, in consultation with the secretary, they're like this, okay, has determined that it is appropriate to limit loan forgiveness to the proportionate 8-week share of 2019 net profit as reflected in the individual's 2019 Form 1040 Schedule C. This is because many self-employed individuals have few of the overhead expenses that qualify for forgiveness under the Act. For example, many such individuals operate either out of their homes, vehicles, or sheds, okay, and do not incur qualified mortgage, interest, rent, or utility payments. As a result, most of their receipts will constitute net income. Allowing such a self-employed individual to treat the full amount of a PPP loan as net income would result in a windfall, again, because of the shenanigans. The entire amount of the PPP loan, maximum of 2.5 times monthly payroll costs, would be forgiven even though Congress designated this program to limit forgiveness to certain eligible expenses incurred in an 8-week covered period. So what they're saying there is they don't want any games to be played here in terms of timing. So they're going to look at 2019 overall, and they're going to make the determination based on that using the formula of the 8 divided by 52 weeks. All right, so let's take a look here. Yeah, so they would limit the forgiveness to a proportionate 8-week share of 2019 net profit as reflected in the individual's 2019 Form 1040 Schedule C. So they're trying to prevent the timing of things from happening, and they're looking at 2019. They're saying, look, it's already in the books. There's no opportunity for really manipulation there. So if you're self-employed, that's how they're going to determine those amounts. All right. So we've got through here. If you guys have questions, definitely feel free to reach out. Let me know. I think we're going to kind of wrap up some of the finer points regarding all of these different programs and wrap this up. All right. So just to summarize here, these amounts have run out, but they can be reopened because we saw that Congress, or at least Senate, is really excited about this new package of $484 billion in relief for small businesses. And that includes $310 for the PPP and $50 for EIDL loans and $10 billion for EIDL grants. That's a big recharge Okay, so the idea here is if you're interested in this, if it makes sense for you, if you've evaluated this with whatever professional you're working with, then you got to strike while the iron's hot. Can't emphasize that enough, because a lot of these banks are playing games on this PPP side. They're prioritizing their big clients. I'm just going to keep it real with you. Some banks are not accepting applications from applicants with whom they don't have an existing banking relationship. Some require you to have a business loan and a business checking account. If you don't, then they're not even going to consider you. That was Bank of America, at least initially. Chase wanted a business banking relationship. So if you didn't have that as of February 15th, then you couldn't apply through them. And Chase has dragged their feet in terms of processing applications that they did get. So I've heard from clients that applied with Chase, and they received an email saying, oh, sorry, we ran out of money and we couldn't process your application. Sorry. So, time is of the essence. If you're interested in these programs, you got to move quickly, because the funds will be exhausted even faster than the first round, because now everybody knows about it. Now everybody has their act together. Millions of people have seen this webcast already, and they're gearing to go. No, not that many, but you got the idea. So time is of the essence. Don't delay if you're interested in one or more of these programs. The other thing is you can just apply for both if you qualify and see where things end up. So you can turn down this EIDL loan once you see the offer. You just say, I don't want it, and keep the grant if you use it for these eligible purposes. That's a strategy. So while you're waiting for this application to process, you might put an application here. So what if they run out of funds on the PPP side again? You may still get a loan here. And if you get the EIDL and you also get the PPP, you have the option to refinance that as part of the PPP. Now, if you used it for payroll, you pretty much have to refinance it, but that's another option. See, now, hopefully, the fact that we touched on all these, you need to kind of imagine these things working individually, but also possibly together to see how this can work out for your business. And clearly, I mean, it can be $10,000 that arrives in your bank account. No problem. Don't have to pay it back if you use it for the right reasons. You have a loan here that you can end up with that you're paying at 3.75% up to 30 years. Also not terrible. That you can use for mortgage payments and a wide variety of things that aren't too payroll specific. You can use it for payroll, but not necessarily. And finally, on the Paycheck Protection side, it's very payroll geared. You're looking at that line 31 of Schedule C, but ultimately, a portion or even all of the funds may be forgiven up to a maximum of the lesser of $10 million or 2.5 times average monthly payroll cost. Again, the thing that's going to really catch people is the complexity of the calculations on the PPP side in terms of maintaining your employees, in terms of determining the loan amount, in terms of determining the eligible uses and the forgiveness amounts. All of those things are important variables here. And really, you're going to deal with the banks here. So they're going to require more documentation. They're going to want payroll records, and we're going to want the Schedule C. We already talked about that. And, you're looking at SBA-approved lenders working with you. So I know that PayPal has been accepted into the program to accept PPP applications. I've heard they are processing them fairly quickly. I don't know if that's going to continue, but that's what I'm hearing. That's what I'm seeing, reading. Also, I understand that American Express Bank may also be taking applications for PPP. So if you don't have a pre-existing relationship with one of these larger lenders, you can possibly look at the smaller banks, the regional banks. They're chomping at the bit for clients, and a lot of them have a requirement that you just set up a business checking account with them or business banking. So not very onerous in terms of the requirements, but they may prioritize your application where Chase or Bank of America or Wells Fargo may not give a damn about you, quite frankly. Just keeping it real, guys. So those are some considerations there. Now, in terms of the prepayment penalties, neither the economic injury disaster loan nor the PPP have prepayment penalties. So theoretically, you can pay them off the next day if you want, and there's not going to be really a problem associated with that. Is collateral required? So let's round out our understanding here now that we're all experts at this and play along. So is collateral required for EIDL while I refresh my tea situation? So if I've done my job today, you guys would know that there's no collateral required up to $25,000. And everybody in my neighborhood is freaking out. There might be a massacre going on, so apologies, guys, for the noise. But this is why I do everything at 3 in the morning. I don't know what's happening. Probably going to end up on the news tonight. No, up to 25,000. All right, so that is the situation there. Now, personal guarantee required. So there's no personal guarantee on up to 200,000. So no up to 200,000 on the EIDL side. So it's very flexible. They really geared this to get the funds out in a timely manner for business owners. So those are the numbers there. Now, in terms of the PPP, you don't require any collateral, no personal guarantee, very flexible. Again, the focus is really on the employees, not so much you as the business owner. And the idea is that you use these funds for the applicable purposes. You calculate monthly payroll costs and payroll costs in general correctly, and definitely mind the details on that side because it's important. Finally, in terms of payment deferment, on the EIDL side, automatically deferred for 12 months. Payments on the PPP side, deferred for 6 months. Now, the eligibility terms on the Paycheck Protection Program, so that's based on the numbers that we talked about here. So let's fill that in. Okay. Do a little bit of word wrap on that bad boy. All right. So then in terms of verification, you got the Schedule C requirement that we talked about, right? So they want Schedule C, they want Forms 1099 miscellaneous, etc. So they're serious about the documentation here. They're not playing games with this. All right, so let's see what else. So now we got a pretty good understanding here of where things play out. You know, under the forgiveness provisions, that's where a lot of the complexity is as well. So really determining the total amount you're eligible for, what the eligible uses are, and the eligibility for forgiveness. That's where the cruxes are for EIDL and PPP. So I'm going to kind of round this out, guys. It's been an absolute pleasure running through this with you. If you have any other questions, feel free to drop them in the chat below. If not, then if you want to reach out and discuss how we can help in terms of getting you a better understanding of these different provisions, then certainly feel free to reach out there. I'm available at alex@efrosfinancial.com by email, or you can just call us at 323-531-3500. And I'm not seeing any questions go through here. So with that said, thank you very much, guys. Hopefully this was helpful. Thanks for watching.